as well as, you see what's happening with the strike with Rutgers. They're asking for a big raise. This is going to keep inflation stubborn. And there's an expression, I think I heard it from Professor Langdana, but I've mentioned it a few times. And as I said, I'm trying to leave you these nuggets of information now that our term is almost done, that once the toothpaste is out of the tube, it's hard to it's hard to put back in. So we have various unions, whether it's Rutgers, pilots unions, others, asking for sizable pay raises, and that will keep inflation higher than perhaps the Fed would like. Steve, question, comment?
Questions, actually. One, when we saw the supply chain break down, we saw prices go up. And we know when oil prices went up, that also added to inflation.
Yeah.
How much do you think the Fed rate, whatever they have for that rate when they raise it, adds to inflation?
I think it plays an important role. So, the whole range of interest rates, right? So clearly the short-term end of the curve, 1 to let's say 3 years, that's impacting short-term borrowings. The 10-year treasury is at 3.4, 3.5%. That's not too bad. If a company's borrowing, at least through the capital markets, that's not too bad. It might be harder to get a loan from the bank. But it all plays a role, right? The supply chain, which is slowly improving, but to my dismay, I've been waiting to kind of get a new car, and the prices haven't really declined much. So that chip shortage is slowly going away, and automakers aren't done. They're selling their higher priced cars that make a higher profit margin. Oil, we've discussed, is an input into many things, including jet fuel and just driving your car, at least if you don't have an EV. That's playing a role as well. So it's all together. It's trending in the right direction. If you back out kind of the owner's equivalent rent, inflation's like 3.5%, which is livable. I mentioned that since we have data, inflation's average around 3%. But the Fed wants to maintain its credibility and doesn't want kind of resurgence of inflation. So I think it's going to keep raising rates at least one more time. And where I slightly disagree with from the consensus, that if you look at the end of the year, we're going to go to 5.25 in May. The market's pricing in pretty significant cuts, which to me says that we're going to be in a recession because, the Fed will probably raise rates and then hold, right? Why it would cut is that if we're in a recession. So the bond market is pricing in a recession, and maybe not a traditional mild one where I'm currently in that camp. Thanks for the comment or question. Any other questions or comments? We meet on Wednesday night, so the number came out today. As I said, on the surface, the market rallied on the headline number. It was up a little less than 1%. Went up down 0.4%. The Biden administration proposed, so it's not guaranteed to get through, that roughly 2/3 of vehicles will be electric by 2032. Now, on the surface, this sounds pretty good, but it can be a problem. So I'm doing this lecture from my New Jersey home, but I also live in New York City, and there's no infrastructure to really charge a car if you live in the city. So, sometimes it's back and forth on these things. I'm a big football fan. Occasionally I've bought Sunday Ticket. Now Google owns it, but it can be pretty expensive. It's $349 on top of the YouTube package, which is a substitute for cable if you just stream from your home. Some companies, I don't know if this is going to affect some of you, but JP Morgan and others are now requiring people to go back to the office. Not 3 days, but 5 days. So my company, my investment firm, kind of requires 3 days for most people. So we'll see. Certainly for the younger people, my son's a freshman in college, so he's not really working yet, but I would encourage him to go in every day and meet people. So I think we're going to see some type of balance, but the trend is probably heading back more for some firms. Let's see what else we got going on. SoftBank is going to sell most of their Alibaba stake, so Alibaba was down a little bit today. Let's see what SoftBank bought them when they were a few $billion, so they still own a big stake. That's why the stock is down. But as you know, Alibaba's splitting in 6 pieces, so I think if you hold all the pieces, you'll be okay. So those were the items I saw in the market. Generally, tech stocks took a hit because maybe long-term interest rates ticked up a little bit. There's a rumored merger between Exxon and Pioneer Natural Resources. Pioneer owns a lot of the shale oil in the mid-continent US. You may have heard of Permian Basin. So there's probably be some consolidation. Obviously, they kind of need to pivot slowly towards clean energy. Other news that happened yesterday, my favorite investor, Buffett, increased his stake in some Japanese trading firms. By trading, I mean more commerce, like shipping and things like that. He increased his stake in like 4 or 5 companies, and they're trading at a PE of 7, and they also pay like a 4 or 5% dividend yield. So there's little risk in them. There's not a lot of growth, but there's little risk. There is some currency risk, but always intriguing. They did ask Buffett about his views on the banking crisis, and he gave sort of a mixed review. He said the deposits will be safeguarded or guaranteed, but he thinks that there's more turmoil to come. And I'm sort of in that camp because we know that $500 billion left banks and went to money market and other funds. So therefore, banks are going to lend less, and the economy was growing at about 1.5% before the banking crisis. So this could push us into recession. And, we're going to have earnings. They kick off on Friday with the big banks, and then over the following 2 weeks, they really accelerate. My guess is that the companies that are experiencing outflows, there might be some shorting of those stocks, and, the media will pick that up in the earnings reports. All right, any questions or comments on anything going on in the financial markets? So I think we did this online thing. I'll get to your question in a second, Ryan. I think we did this online thing once before, and you might recall, I generally prefer to take 2 shorter breaks after each hour than 1 in the middle. It's just hard to pay attention, with Zoom. Ryan, you had a question?
Hi, sir. Yeah, just for McDonald's in particular, when they're laying off these office jobs to be more efficient, I mean, what's that really targeting?
Well, we sort of joked about this with Facebook / Meta. They basically said, okay, nobody's going to have a job where they just manage other people. You have to be doing work. McDonald's, I worked at McDonald's when I was a teenager, so I know the company pretty well. Much to my wife's chagrin, occasionally I go to McDonald's just because it's fast and it's cheap. And when I've gone in there, there's more and more kiosks. If you're lucky if you find more than one person working the counter. I can share the screen on this. McDonald's, they're a great marketing organization. They're sort of a real estate corporation. It's surprising how much their executives are paid. $6 million, and this is without any stock options. I remember McDonald's CEOs being paid like $20 million. So it's not surprising that there's some kind of mid-manager layoffs, but that's sort of the trend everywhere. So, without looking at the company's financials specifically, it's hard for me to comment, but there's definitely a trend towards automation. Rocco?
I don't know if it's new or not, but my fiance on the TV last night had some movie about like the start of McDonald's and kind of how it was built.
The founder?
Yeah, the founder, right? Yeah,
I saw it.
It was good.
Pretty good. Yeah.
It was interesting.
Yeah, I thought the movie is pretty good. I'd give it a B. it's sort of negative towards Ray Kroc, who is the milkshake machine salesman that bought, or some would arguably kind of stole the company from McDonald's. And we've chatted about this. McDonald's owns less than 10% of the stores. It's a franchise business model, and they make a lot of money from real estate in addition to the franchise fees. So I would say if you get some downtime, we're entering the end of the semester after finals. I would say it's worth watching, both from an entertainment standpoint and also from a business standpoint. But yeah, thanks for bringing it up.
Yeah, I thought it was a great movie for sure. Yeah.
Yeah.
Yeah, my favorite part of that movie was when Ray Kroc was told by the consultant that he wasn't in the hamburger business, he was in the real estate business.
That's right. And that surprises a lot of people. But if you look at their margins, they're super high. And the reason is because of franchising as well as somebody's paying rent. And not only that, McDonald's, let's say McDonald's in a strip mall, they know that's going to generate a lot of traffic. So they often buy the real estate in the strip mall and are able to monetize that as well. So they're pretty sharp there. They've raised prices. As I said, I've been McDonald's plenty of times, and you're paying pretty much anywhere close to $15 for like a Big Mac, fries, and a shake or whatever. And this food inflation, I know that egg prices dropped today, but it's pretty rare to see companies like Chili's or whatever. They're not really going to lower their menu prices. They might not raise them for a while, but that food inflation is here to stay, and goes back to the expression about the toothpaste ahead of the tube. Some things like gasoline, that's pretty volatile, that can go down, but a lot of these other things, salaries, that tends to be pretty high in terms of not cutting somebody's salary once it's there. All right, any other questions or comments? Okay, so just give me a second to open up our hedge funds lecture on where we kind of left off last week. All right, I'm ready to share the screen. Okay, just give me one more second here. All right, so we left off just introducing specific hedge fund strategies. I'll just briefly kind of repeat a couple of things. This is a menu of the most popular hedge fund strategies. We'll cover a handful in our time tonight. And I mentioned I teach an MBA class in the fall. Probably for most of you, it's not going to work because it's 1 to 4 p.m. in Newark. And each class, we focus on a specific hedge fund strategy in detail. We're going to kind of give the Cliff Notes version tonight of a few of these strategies. And one of the things that we said is different from your typical mutual fund is that hedge funds can use leverage. And in some cases, they can use a lot of leverage. You can see these fixed income ARB funds can use up to 30-to-1 leverage. Sadly, we're not going to have time to do risk management. One of the things I talk about in risk management is the story of long-term capital management. If you're looking for a good book to read, besides watching The Founder, it's When Genius Failed by Roger Lowenstein. It's the story of long-term capital management, which were among the smartest people on earth, but they blew up their hedge fund. And part of it was because of hubris, but also part of it was because of leverage. Mutual funds are prohibited from using leverage. Closed-end funds, which are a special type of fund, can use a little bit of leverage. And then we have some leverage ETFs. But by and large, one thing that's different about hedge funds, besides taking a cut of the profits, is the leverage. And this is where we left off. I talked about this guy, A.W. Jones, Alfred Winslow Jones. He was one of the first people to set up a hedge fund. He's credited with developing the industry. I don't think he had the first hedge fund. And we went over this mini spreadsheet that had the A.W. Jones formula, which is basically long dollar minus short dollar over capital. And capital is what you have if you cash out. Your typical hedge fund is long a dollar for 50 cents. They're short, but they can do it dynamically. And this simple model that A.W. Jones went over that we covered last week is still in use today. Just a brief recap of short selling. We've talked about it quite a bit in our class. The way most people try to make money is buy low and sell high. Right? You buy and then you sell at some point in the future. When you do it in the reverse order, it's called short selling. So the distinction between selling and short selling is you're selling a security where you have no prior position. If I buy IBM today and sell it next month, that's just a regular sale. A short sale is you sell something where you have no position. How it works is that the brokerage firm has an accounting system that keeps track of it. They borrow the shares from somebody else who's completely oblivious. They give them to you. If there's dividends, you have to pay the dividends, and then eventually you have to return the shares. Some securities, like Johnson & Johnson was one I may have mentioned, you can short J&J for 10 years, never get a phone call. But if you're trying to short stock that everyone else is shorting, AMC, GameStop, you're at risk of having a short squeeze where they'll say, okay, you have to cover the short even though you're not ready. Not to get into the weeds and don't really worry about it for the exam, but there's something called a hypothecation agreement. When you open up a brokerage account, very few people read the fine print, and the fine print says they can take your securities and lend them out to somebody, which is primarily a hedge fund. And your broker is making money off of you, which not there's anything terribly wrong with that, but most people are oblivious to what's going on. So you sell first and you buy back later. In this instance, it's working well where the stock went down. Company in the news, I think on Tuesday, was Tupperware. They came out with a going concern issue, which means they may be going bankrupt, and that stock plummeted. But the opposite can happen, right? NVIDIA is up 80% this year. Not that that would be a good short, but you can short a stock and have it go up, and there's theoretically unlimited upside. Adding to your movie list, there is that kind of little mini series on GameStop on Netflix. I saw it. It was pretty good. Goes by quickly, so I would add that to your list as well. There are very few funds that are net short consistently or only. There's one guy, James Chanos, that you may have heard of years ago. He was in a Barron's cover article called The Man Who Called Enron. Occasionally he's popped up in Billions. I think I mentioned I'm a fan of the TV show Billions. There's a firm, Spruce Point Capital, run by a Rutgers guy. He's a pretty well-known short. You can Google him up. His name is Ben Axler. We talked about Hindenburg. We talked about the Adani short, Muddy Waters. So there's a couple of dozen firms out there. But in general, very few people are short only and survive because on average, the market goes up 10% per year. So, I think they're probably better off being market neutral. All right, so let me kind of go to a couple of spreadsheets I put on Canvas. These are mini spreadsheets that illustrate some points. And just give me a second. Here's the screen. So there's all sorts of ways of making hedge fund investments. I showed you, I think, a video last week about looking at oil refineries and shadows and building up glass tables and tearing phones apart and all sorts of things. I may have also shown you Bill Ackman's 300-page PowerPoint on Herbalife, which didn't work out for him. So point one I want to make is that there's often a ton of research that can take weeks, months, years before the short is instituted. So in this little mini example, we're going to go long in IBM and short Exxon, and the dollar amounts aren't the same. So this is a long short trade as opposed to market neutral, which we'll do. And I'll sort of answer these questions on the fly. Occasionally I'll ask for your input. Long short ratio, you typically take the absolute value, or you can put a minus sign here. So I'm just going to take this divided by this. If you wanted to be more precise, you can adjust by the beta. But long short ratio is this manager long $1.66 for each dollar that she's short. Is the manager bullish or bearish on the market? I'll say, bullish, because the long is much greater than the short. Fund market neutral? No, we'll get to that, since the beta and dollar amount differ. You might remember way back in the beginning of the year, we talked about arbitrage, and we had those three conditions: zero risk, which means your beta of your long portfolio equals the short portfolio; zero net investment, which means your dollar long and short investment are the same; and then positive return. The fund is not sector or industry neutral, since tech and energy are different sectors. Let me open this last one up to the class. What can go wrong with this trade where I'm long IBM and short Exxon? I can think of at least three things, but anyone want to comment? How can I lose money in this trade here, going long 200,000 in IBM and short 120,000 Exxon?
Well, they could move opposite directions. I mean, there could be a squeeze on oil and technology could take a hit, and then you're losing both ends of the trade.
That's correct, Steve. Thank you. I've been there where it's not fun, where your long goes down and your short goes up. So
That's similar to what happened during the pandemic, right, Professor?
yeah, I mean, there weren't a ton of short positions. I mean, it did happen with some hedge funds that, a lot of the big hedge funds, like Bridgewater is one that comes to mind. When the pandemic hit, they kept going short, and then we had a huge rally. So the main risk is the long goes down and the short goes up, which is the opposite of what you want to have happen. But, I can think of at least one other thing that can go wrong with this. I mean, you're obviously paying dividends on the short, but any other thoughts? Well, in a bear market, you will probably lose money, since you are long $1.66 for each dollar short. So if you have a crash of 1987 type scenario, or even March of 2020, where it went down 30% in a month, you'll still probably lose money, even though you have a partial hedge here. And this strategy can be applied to any market that permits shorts. So as an example, in mainland China, it's very difficult to short. You can short in Hong Kong. I think in France, they may have banned short selling. Those that remember the Great Recession, there was a time where they actually banned the short selling of financial stocks and stocks that had a financial component like GE. You can't really sell short real estate. You can't sell short art. So, it can be applied to many asset classes, but you need to be able to have that short functionality. All right, so that's long short. And now I'll pull up market neutral, which was the next slide. I have a lot of these mini spreadsheets that sort of illustrate the point. All right, just give me a second to close the file and show the screen. All these files, as I said, are on Canvas. This is a mini example. And in this case, we are long IBM and short HP. It's sort of similar. Their betas are about the same. I'm going to assume that I've done an equal dollar amount. This is what we call a market neutral example. I'm also going to call it pairs trading a little bit later, but I don't want to mix too many metaphors. So the first question says, does market neutral have to be in the same industry or sector? Technically, no. Market neutral means the beta and dollar amount of long and short are the same. If they are in the same industry, it's called pairs trading, at least similar market cap as well. And we'll do an example in a few moments. The approach can be either, but I would say the quants are gaining share. You've probably heard of firms like D.E. Shaw. I mentioned Renaissance last week, Two Sigma. Let me pose this last question to the class. In market neutral hedge funds, do you think it makes sense to use much leverage? Any guesses?
Nope. Since whatever goes up will come down.
Yeah, it really depends on the manager. We had a slide that said anywhere from 1 to 5 leverage. I would say usually, because you have eliminated the market factor. So you're left with your ability to say company A is better than company B, in our case, IBM and Hewlett Packard. So the rule of thumb is the more hedged you are, the more leverage the broker will allow you. And if your beta is the same, if the dollar amount is the same, if you're in the same sector, these are all hedges, and these companies are largely in the same industry as well. So it depends, but generally there is moderate leverage in this. Not as much as fixed income are, but still some leverage. Any questions or comments on the examples we've done so far? All right, let's keep moving along here. Now, not that any of this is terribly complex, but the one I'm going to do now, statistical arbitrage or stat arb, has multiple steps. So it'll be the most complex thing that we're doing tonight, but it's basically algebra with, let's call it 4 or 5 steps. But it's a pretty cool trade. I'll explain it, piece by piece. And I'm going to differentiate statistical arbitrage from what I'll call regular or pure arbitrage. You might remember way back in the beginning of the semester, I said, what if I buy IBM in New York and sell it in London when there are different prices? And we also talked about this thing called dual share class arbitrage. Those examples are what I'll call pure arbitrage because it's basically the same company. Statistical arbitrage means that the overall portfolio level statistics are the same beta, same industry, similar market cap, but there's always like company specific risk. If I'm long Ford and short GM, there's always a risk that, let's say, Toyota buys them or Tesla buys them, right? So that's why we call it statistical arbitrage and not just regular arbitrage, because there's some differentiating factors in your long versus short portfolio. I'm going to pull up a picture of the normal distribution just to kind of refresh your memory what it is. And I'll also pull FinViz up in a second, so just give me a minute. I'm just going to try to share my screen now. All right, so first of all, you might say, how do I find these pairs? Well, there are functions within Bloomberg that look at correlations and find pairs for you, but it's not hard, right? So Visa and MasterCard are a pair. Same industry, similar market cap, similar beta. You could look at Pfizer and J&J, they're a pair, or Merck. So a rough rule of thumb is that correlation should be like 80% or higher, same industry, not too different in market cap. So it's not hard to find pairs. You can sort of eyeball it, or you can do a more mathematical analysis. And what we're going to do is we're going to look at the ratio of the prices of two stocks adjusted for splits. And why I'm pulling up the normal distribution is that most of the time, the market is fairly efficient and there's no trade to put on. So in a second, I'm going to pull up a spreadsheet. And what I'm going to say is the ratio of the two prices is going to be somewhere in the middle, so there's no trade to put on. But occasionally prices get way out of whack. By that, I mean you're at the right tail or you're the left tail. The example I'm going to do is PetroChina and China National Oil. So when the ratio of the prices is really high, I'm at the right-hand tail, I'm going to go long CEO and short PetroChina. When the ratio is really low at this end of the tail, I'm going to do the reverse trade. I'm going to go long PetroChina and short CEO. And then when the ratio goes back to the middle, I'll undo the trade. I'll take it off. So that's a big picture discussion of what's going on. It's basically looking for deviations from the mean, substantial deviations, and betting on mean reversion, which typically occurs in several months. All right, so here's the spreadsheet I hope you're seeing. I'm usually pretty with it. If not, let me know and I'll try to share the screen. You're typically looking at 2 years of daily data or 5 years of monthly data. And you take the ratio of the prices adjusted for splits. You can get the data on Yahoo for free. You can get Bloomberg. And over here, I'm taking the average of this ratio, 1.27. So the midpoint of the normal distribution is going to be 1.27. Now, stock prices are not normally distributed, but it's a rough approximation. I would say log normal is actually a better approximation. And the reason is that unless you're using leverage, you can't lose more than 100% when you go long, and you could make more than 100% if the stock and it takes off. So I'm going to take the standard deviation of this column, which is the ratio of the prices. And then you may have had stats a while ago, but you probably remember that if you take the mean plus 2 times the standard deviation, that's the right-hand side of the tail with 95% probability. And then if you take the mean minus 2 times the standard deviation, that's the lower part of the tail. So in plain English, and I'm going to pull this up on the next slide, and then I'm going to the next tab, and then I'm going to have a graph. If the numbers are between 1.4 and 1.09, I'll say prices are okay. I'm not going to do a trade. But once they pierce the upper bound or pierce the lower bound, I'm going to put on a trade and then undo the trade when it goes back somewhere in the middle. All right, so let's keep these numbers in mind, 1.45 and 1.09. So this is the, let's call it back test, or just the estimating the parameters. And let's say this was today's date, or 12/23. I'm going to look at the ratio of the prices, and I want them to be higher than the upper bound or lower than the lower bound. So here I'm saying no trade, no trade, no trade. And then notice I've pierced the upper bound. You can only be true in one position. You can have 2 falses, but you can't have 2 trues. It's easier to see in this, right? So this is the ratio of the prices. So no trade, no trade, no trade. When it pierces 1.45, I'm going to say, hey, the prices are out of whack. We're more than 2 standard deviations. In this case, the ratio is too high. When the ratio is too high, I'm going to go long CEO and short PetroChina. Notice how the trade is actually going against me. I'm losing money. But as long as it goes back to the middle somewhere, then I'm making money. So this is a mean reversion trade that happened. So let's say I put the trade on here and took it off over here. So I'd say no trade, no trade, no trade. And then over here, I'm going to eventually do the opposite trade where notice the ratio got too low. So I'm going to, this one go long PetroChina and short CEO, and notice how it goes back to the middle. So this one I made money much faster. So in plain English, StatArb is a strategy with a portfolio of stocks, and there's usually dozens, especially if you look globally, maybe over 100. It's basically a play on mean reversion, and most of the time it works pretty well, but sometimes it doesn't work well, and how you can handle that is you cut your losses. So let's say you found AMD and Intel as a pair. You may know that Intel has fallen apart and AMD has done extremely well. So how you kind of deal with this in reality is you have a diversified portfolio, and then you have a stop loss order that if the trade goes against you, you just cut your losses, say, okay, I made a mistake, and you move on. Occasionally there's a takeover where a stock that you're short gets taken over, but fortunately that's not extremely common. And if you're having 50 or 100 names, which you can if you're looking globally, the hit is manageable. So I think it's a pretty cool strategy. You can Google the term pairs trading. You'll find a bunch of books come up on it. And it's very popular in the quant world. Any questions or comments on StatArb? All right, so not that was terribly hard, but that's the most deep thought we're going to do tonight. Everything else is first or second level thinking and doesn't have these multiple steps.
So really quick, which of the two is the divisor when you do the arbitrage?
It doesn't matter. You can just, in my case, I took PetroChina divided by CEO.
The long Petro over.
Yeah, I did
CEO.
Petro over CEO.
Whatever your long is okay, I understand.
Yeah, so you're basically computing a ratio, and you're seeing what the mean of that ratio is. So in our case, the ratio was like, let's call it 1.2. But if I did the opposite, the ratio could have been 0.8, and that would have been the midpoint of the normal distribution. So it really doesn't matter because you're just looking, it's like one's the reciprocal of the other.
Mm-hmm.
Looking for is just deviations, substantial deviations from that historical mean.
Gotcha. Okay. Yeah, I was more so just clarifying which one was
Yeah.
when you're long kind of the order.
Yeah, the one
for
I
the,
did
for the
China. Yeah, PetroChina over CEO. And as I said, those numbers should be adjusted for stock splits.
Thank you.
Yep. Global macro is one of the biggest hedge fund strategies out there. I mentioned Bridgewater a couple of times. I think I mentioned George Soros a couple of times in class. Global macro can handle theoretically unlimited amounts of money. Not that they don't trade individual stocks, but the focus is on big picture items. Which country, which currency, which index, right? You can put $50 billion to work in SPY, not in one day, but you can put it to work over time. And the FX market's the most liquid in the world, right? So global macro, the name's exactly what it sounds like. You search the world globally, and you often are using derivatives to get leverage. You're often using index securities because there's the most liquidity in this. In addition, global macro is often unhedged. So they're sort of the gunslinging area of the hedge fund universe. So on paper, they're one of the higher risk categories, but surprisingly, and maybe because they just watch risk like a hawk, during down years for the market, like last year, like 2008, they didn't really lose much money. So I think they're pretty good risk managers. They also do something called a carry trade, which I don't have in the slide deck, but if you follow financial markets, the carry trade is where you borrow money where it's cheap. So right now, Japan, interest rates are still like 1% or less. Let's ignore currency movements for the moment. If I borrowed money from Citibank in Japan at 1% and invested it in treasury bills, which as of May are going to yield 5.25%, I'm making a spread of 4.25%, and I could use leverage. Now, of course, there is some currency risk in that, but my point is that these global macro hedge funds actively engage in the carry trade when rates are low, or in some cases they were negative, and they can invest it in higher yielding assets. Merger arb is one of the older hedge fund strategies, but I kind of use it as a fixed income substitute sometimes. I'll show you a fund in a moment, the merger fund. And there's a lot of ways to kind of play mergers, right? So most of the merger funds out there, they trade on announced deals. There are some firms that'll speculate, like I mentioned, Exxon potentially taking over Pioneer. The deals can be all cash, like Microsoft is trying to buy Activision. It could be stock for stock. It could be a combination of stock and cash and debt. And the main risk is that the deal falls through, right? So often, the Justice Department is challenging Microsoft takeover Activision. The takeover of Time Warner by AT&T, that took over a year to go through. And the expression is you're picking up a penny in front of a steamroller, because what happens is that when a deal is announced, the stock jumps right away. You can't get it at that pre-market price. So there's usually a little bit of money left on the table. Let's say 3 to 5%. But if the deal falls through, you're probably losing that entire takeover premium, let's call it 30%. So you need a very high batting average to make money in merger arb. Since we have time, I'm going to show you, it might be of interest. I've put some clients in this fund. It's called the Merger Fund, MERFX. There's an ETF out there. And they were the first game in town. So they have 3.8 billion. And, they charge, let me click a profile here. They charge like a 1%. 1.3%, let's just use round numbers, 1%, and let's say they have 4 billion. So they're making $40 million a year, basically saying, hey, what mergers have been announced, and let me just buy a basket of them and hold it. And you can see some of the holdings that they have here. What I want to show you is this performance. So I view this sort of as a bond substitute. What you'll notice is they rarely lose money, and they usually make a little bit of money. So last year, this was a good diversifier because bonds got crushed. Right? Occasionally, there's some larger losses, and occasionally you can earn teens. But this is, a mutual fund that anybody, and they're not charging 20% of the profits. What they can't really do is use much leverage in a public mutual fund. But you can see I'm doing the Cliff Notes version of a sample of the hedge fund strategies that are out there. The main risk is the deal falls through, usually because it's disallowed by a government agency, but occasionally the financing falls through. Occasionally you can make money by reading the news. Here's a trade I actually did. I read this article. We all know about NVIDIA. We did a bull bear case on it. And I mentioned, in that discussion that they're getting into the server kind of farm business, and they bought a company that you probably never heard of called Mellanox. I owned the stock at one point, which is why I know something about it. And they had a good value proposition. The cost was half that of Cisco, and their hardware is twice as fast. So you basically have a 4-to-1 value proposition. So I read this article, and if the deal closed as was proposed, you could have made a 30% rate of return. So I knew NVIDIA had the money, not to mention their stock was on a tear. I knew this was a business they wanted to be in, but if you remember what happened a few years ago, there were some tensions, as there are now, between China and the US. They arrested the executive from Huawei. So the Chinese government was holding up this deal, even though there was no really antitrust threat. Bottom line, the deal eventually went through, and this is an example of a merger cash deal. At each particular point in time, there's probably about 30 to 50 mergers going on. It's sort of cyclical. The more ebullient the market is, the more mergers are going on. A merger that has absolutely, let's call it, no hair on it, that can close as soon as 3 months. Your typical merger takes about 6 months to close. If there are some antitrust concerns, it could take a year and sometimes more, like we saw with the AT&T and Time Warner one. This is a nice simple calculation, but you might want to have it on your formula sheet or sheets. I'm sure most of you remember I'm going to permit 2 sheets for the final. Let's look at the example and work backwards to the formula. So one question that, if you trade in mergers, and how I occasionally do some of these things because I think it's sort of low risk most of the time. There are people on Seeking Alpha where their kind of newsletter or whatever you want to call it focuses on, merger arb. Sometimes they call this risk arb. Let's look at the example. We got the stock trading at $20 a share, and then a deal is announced to buy it at 30. Well, right away, the stock's not going to jump to 30 unless there be multiple bidders. There's 2 reasons. Number one, the deal can fall apart, and then you lose that entire $8 premium, maybe more. And 2, time value of money. As I mentioned, your typical deal is taking about 6 months to close. If the deal takes more than that, right now, short-term rates are 5%. So let's look at the calculation. The probability the deal closes is the current stock price, 28, minus the price before any deal was announced, divided by the price if the deal is closed, 30, minus the price before the deal is announced, 20, which is 80%. You could do this with Activision and other announced deals and see what it comes out to be. I would say if the number is less than 70, 75%, there's substantial doubt that the deal is going to go through. So you might want to keep this on your formula sheet. This could show up in like a multiple choice question. There's not much thought in this, but it's a nice simple example. Another good strategy is event driven. It's a broad category, right? An event, there's a multitude of events. It could be a merger. It could be a special one-time dividend payment. We're starting earnings season in earnest with JP Morgan kicking off on Friday. It could be an upgrade. It could be a downgrade. It could be a new product announcement, new service announcement. It could be a market, kind of a product announcement. It could be a macro thing with the Fed. But the basic idea is that once the event has passed, you kind of move on. So event-driven, the holding period could be from 1 day to a few months, as opposed to some of the other ones that may take, much longer. So I think it's kind of cool. And there are some event-driven mutual funds out there. BlackRock has one that I know of. Now, I don't think we're going to have time to do it, but I was going to show you another video on Carl Icahn, who's in his 80s. He's one of the main corporate raiders / activist investors. And an activist investor purchases a sizable stake in a company and then pushes for changes. The changes could be a change in strategy, change in buybacks, selling the company. And, why do you need a sizable stake? Well, the reason is that, if I buy 100 shares in a company, nobody's going to listen to me. If you're one of the larger shareholders, management's sort of obligated to at least entertain your views. And I'll show you, an example. Bill Ackman, I've mentioned a couple of times. He's a younger version of Carl Icahn, a little bit nicer. And his firm's called Pershing Square. So if I click on all holdings, this is his entire long portfolio. He's got 6 stocks, right? A hedge fund can do this. A mutual fund can never get away with this. The most concentrated mutual funds out there, you've heard of like a fund like Janus 20, So there are diversification constraints on a mutual fund that don't exist in the hedge fund space. So he owns $2 billion of Lowe's. That's a sizable investment. They can't ignore him. This is quick service restaurants. They own Burger King, Chipotle, Hilton's. So my point is, step one, if you're an activist investor, you take a sizable position. This way you get a seat at the table. And surprisingly, even Microsoft can be hit by activist investors. You know, hindsight's 2020, it turned out to be fantastic. But you can Google this. Around 8 or 10 years ago, there's a firm called Value Act. They took a position in Microsoft and sort of pushed Steve Ballmer out. And obviously Satya Nadella has done a great job. So Icahn is the oldest. He's in his 80s, still working, because making, $500 million a year. And I'll just read some of the things. He says, it's our contention that sizable profits can be earned by taking large positions in undervalued stocks and then attempting to control the destinies of the company. So he's pushing for changes. How can he do that? Well, one, try to get the company to sell to a white knight. Warren Buffett is like a white knight, right? He's friendly generally to management. Large companies, it's unlikely they'll just kind of fold up shop and liquidate. If we had more time, I would show you the Gordon Gekko speech, Read is Good. That speech was a proxy contest. Proxy means vote. So you can try to get votes of other fund managers and then vote yourself and your friends on the board of directors. A tender offer is try to buy shares from other shareholders and then once again control the votes. And then there's a term called greenmail that was common in the 80s, but the SEC has largely outlawed it. Greenmail is that the activist can be kind of a pain. So let's say I'm a Carl Icahn, I'll say, all right, give me a 20% premium to my shares. I'll give you my shares and I'll go away. Now, the SEC doesn't like that because the small investor doesn't get that same deal. But that was happening, that happened quite a bit in the 80s and 90s. So Carl Icahn is the best known corporate raider. He's in his 80s. There's some younger people, Bill Ackman and Dan Loeb, they're probably in their 50s. There's another guy, Paul Singer from Elliott. And it can get kind of nasty. So I have this screen capture of a letter that Dan Loeb wrote to the CEO of a company called Stargas. The CEO's name was Eric Seven, that's his name. So let me just read this and you might get a chuckle out of it unless you're related to Eric Seven. A review of your record reveals years of value destruction and strategic blunders, which have led us to dub one of the most dangerous and incompetent executives in America. It gets worse. I was amused to learn in the course of our investigation that at Cornell University, there's an Eric Seven scholarship. One can only pity the poor student who suffers the indignity of attaching your name to his academic record. That's pretty harsh, man. The guy set up a scholarship and you're kind of ripping on him. By the way, we talked about Tim Griffin last week, who made $4 billion last year. He gave $300 million to Harvard for their School of Arts and Sciences. And yeah, I wonder what the price tag is for Harvard Business School and also Columbia Business School. I think it's probably $500 million because Booth in Chicago went for $300 million. Okay, one more paragraph here. It's time for you to step down from your role as CEO and director so you can do what you do best. Retreat to your waterfront mansion in the Hamptons where you can play tennis and hobnob with your fellow socialites. The matter of repairing the mess you have created should be left to professional management and those that have an economic stake in the outcome. Sounds like a pretty bad Alanis Morissette song, and it's pretty rough. So this is in public documents, anyone can see it. I'm sure Eric Seven wasn't happy about this. And I don't remember I think the guy left the company and something happened. So this is what activists do. They agitate, they push, they might start out nice, but you can look at Dan Loeb and Campbell Soup, who he's doing a campaign there as well. And, I'll pull up Campbell Soup here. There's a little bit of truth to it because often they're picking on a stock that hasn't really moved in a while. So Campbell, headquartered in Camden, New Jersey, in case you live in the South Jersey, Philly area. So this stock really hasn't moved since 1997. I mean, this patience, and then there's like, this is going on like 25 years, the stock hasn't moved. It's moved up and down, but hasn't moved, and you've gotten a dividend. So you can see why there's some frustration. They usually pick a company that has moved sideways to down, has been mismanaged, and then they try to push for changes, including the sale of the company. Let me pause and see if there are any questions on anything we've covered so far. We're going to take a break in a minute, so just hang in there. I'm just going to look here. Yeah, I mean, we only have 2 slides left, so we'll do these 2 slides, and then we'll take our first break. So I've given you a Cliff Notes version of a range of strategies, and there's a couple other ones. Multi-strategy is exactly what it sounds like. Let's say we have the Rutgers MBA hedge fund. I could take that money, let's say 10 million. I can give 2 million to the long short team, 2 million to the global macro team, 2 million to the merger arb team, and so forth. So you're basically diversified across strategy, but it's still the same company. If you're Madoff or FTX, you can still blow up. But you get diversification. Another approach, which is more of a marketing thing, is the fund of funds business. So I raise money and I can give, let's say, 2 million to Soros, assuming the minimum investment was that low, 2 million to Bridgewater, 2 million to David Tepper, and so forth. Now, the problem with fund of funds is that there's another layer of fees on top of that. So we mentioned last week, your typical hedge fund is charging 1 or 2% of assets and 20% of profits. The fund of fund is charging another 1% of assets and 10% of profits on top of that. And no joke, I once heard of a fund of funds. We have 3 layers of fees, so that's even crazier. But you get instant diversification, because we talked about last week, your typical minimum investment's $1 million. So to create a diversified portfolio on your own, you probably need $10 million, which a lot of people don't have. All right, so that's our little introduction to hedge funds. Any questions or comments? Let's take our first break. We'll come back at 7:10 and then pick up with private equity.